Well, as we always do, or at least for the last, I think, 3 months, Larry and I, good morning, Larry.
Good morning.
Larry and
Happy first Saturday.
First Saturday of the month, job, the next day after job, something, I don't know. Anyway, yep. Cathie Wood does her thing on the first Friday of the month, and she talks about what happened in the world of economics and the world of finance. And then Larry and I, the next day, we sit down and we figure out what did Cathie say, and we add our own analysis on top of that. And Larry, your first comment was, Cathie is smarter than the Fed.
You know, we've said all along on this first Friday that Cathie's wiser than the Fed. And the theme of everything that I've said, you know, on this channel and whoever I speak to is that inflation is not the danger here. Recession is the danger. And Cathie has this view that we're in a rolling recession. I have to align with her. There are a lot of people hurting in this country. And, you know, somebody said, well, what about wage inflation? I said, the only inflation I see in wages really is the tip rates.
The tip rates, yeah. Yes.
They've gone through the roof. But other than that, I think, you know, wages have gone up, but actually real wages and have not exceeded productivity. Well, we'll see that. I mean, what I suggest we do is we look at Cathie's slides and we talk to them. But in essence, what Cathie's telling us is we're turning the corner. Even the Fed is beginning to understand it. I don't think that they yet accept that they've gone on too long and too high. We are going to suffer that error, but it's not too late for the Fed to relent. And, you know, this Fed could hold these rates at these levels for another 6 months because they're so spooked about this issue of inflation.
But if we have clarity on inflation, so if the PCE really does come down to the levels that we're seeing on trueflation, if the PCE and the CPI, you know, are in agreement, especially if it starts to show deflation, I think the Fed could react more quickly this time. At least they might learn the lesson of not waiting too long.
Well, they've waited too long.
Twice. I mean, twice. So I'm thinking the third time, maybe they'll get it.
The third time.
Yes.
Third time lucky.
That's right.
You may be right. You may be right.
Of course, now I'm going to disagree with you and Cathie, of course, because I don't believe there will be an actual recession. Now, I said on my show a couple of weeks ago, does that mean that we couldn't have another one of those deals like we had last year, where you have 2 quarters in a row where it's slightly under, you know, performing? Yeah, that could happen. We could have a technical recession in that regard again, but I don't see the kind of recession where everybody goes, oh my gosh, we're in a recession.
Actually, Cathie and I are not saying that.
Okay.
What we're actually saying is that we are in a rolling recession.
Right now, yes.
The recession that we're experiencing now is like none, like very few that have happened in the past or that have been measured or recognized in the past. And, you know, it doesn't fall under the rubric of a technical recession as defined, but I think it's very real. And I think it's being experienced, you know, very acutely. If you look at the banks below the big 5, 4, or 3, whichever way you want to, I mean, the banks are hurting really badly, really badly. And actually, even the 3 of the top 4 banks are technically insolvent by any reasonable measure.
They got a lot better last week.
They're not technically, yeah, they did. they're not technically insolvent. They're technically significantly handicapped in terms of the capital. I mean, it depends on what you require by way of capital reserves. And so under any reasonable measure, it's crazy that the degree at which they are impaired. It's crazy.
And so for the audience, what Larry's talking about is that the Bank of America in particular, but a bunch of the banks have these long bonds. They have the 10-year bonds, and they own them at 2% or 3% interest rates on those bonds. And so when they went to 5%, it made their asset technically worth a lot less than they had it on the books.
If you or I or any corporation owned those bonds, we would be required to mark those bonds in any financial report. We would be required to mark those bonds down to their current market value.
Each quarter, yeah.
Each quarter. Because they mature in 5 to 10 years' time.
Right.
And if money is required today, we wouldn't be able to liquidate those bonds to provide that money today.
Right.
And so we would be declared bankrupt. But the banks are saying, oh, no, we intend to hold these bonds until maturity. Well, intentions are all very well, but actually the value of those bonds right now are way down. And so if you looked at Bank of America, its capital ratios would not comply with the bank's requirements for capital ratios. And in normal circumstances, there'd be a run on the bank. They wouldn't be able to meet the run. Bang. But the government is saying, no, it's okay. Those bonds, we will allow you to realize in good time, and we will, mark them as fully valued.
Right.
Very clever.
Yeah, it's good.
Very clever. Anyway.
Yes. All right. So, and the other thing that Cathie talked a lot about on this one was the productivity, which has been my hobby horse, and which we had the great results on Thursday. Productivity showing strong gains, and how that impacts the market, and it's really beginning to show.
Well, that's part of the story. So what I suggest we do this week is, the story is so that she presented in such a well-structured way. Why don't we walk through her step by step to show how she reaches her conclusions, and look at the slides that she showed us. All these slides are slides from Cathie's firm ARK Invest, and they were prepared by ARK Invest based upon multiple different sources. And so I suggest we just go ahead and show them, and I think that would give us an inkling of what she's talking about. Does that sound good?
Yeah, go ahead and put them on up, Larry. I was also, while you're doing that, I was also going to remark that the rolling recession idea can also potentially be seen in the fact that the S&P and the NASDAQ are down into correction territory. And so that might be the market saying, oh yeah, we see what's going on here.
Exactly right. So let me just arrange myself here. So I take it you're seeing your
slide is beautiful. Yes.
So Cathie says she's very excited about the fact that we may be turning the corner. And so from every perspective, we think we're getting better. Now, she did say that on fiscal policy, there may be a government shutdown because of the budget, because they're unable to pass a bill for Biden to sign to accept a higher level of deficit. There's a limit. The government has set a limit on how much the deficit can be. And in order to fund the government, they're going to have to increase their deficit. And it needs an act of Congress, and Congress is split. And we may have to get another continuing resolution. We're so used to it now, Cathie says, that, it's business as usual. And she thinks they're going to kick the can ahead to next year. it's got to a point where it's no longer a crisis. It's like every day.
Yeah, exactly.
And the other issue that she spoke about was that there's an executive order now to say that all of these government agencies, I don't know how many, 30 government agencies have to, look at AI and have to regulate AI. I haven't read the order. I've heard really terrible stories about it. It affects, every one of, it affects my investments quite dramatically because, I happen to be invested in a company that is involved in AI. So
Yeah.
It's a bit worrying when the government gets this crazy. So we'll see. I mean, Cathie believes that this is an issue that's going to come up in the election.
Yeah, well, I think Elon and others in the high-tech world have definitely said, look, we need some regulation.
Yeah.
They've called these fellas in, guys and gals in, to discuss what kind of regulations might be necessary or appropriate. And then the government just goes off and does something completely different than what they were advised.
It takes a meat cleaver. This executive order is a meat cleaver. It's going to cut the whole industry in half.
Right.
Actually, it's going to cut the industry into 15/16 on the one side and 1/16 on the other side. The 1/16 are the wealthy companies, the Googles, the Microsofts, and maybe even the Teslas, but they're going to be the winners. And everybody else is going to be the losers. And Cathie thinks that this is going to be an electoral issue.
Right.
I don't think people will be able to understand it. This and Bitcoin are not going to become, in my view, electoral issues. And I think Cathie's wrong on this regard.
Yeah, but it does go to show you're about 3 or 4 or 5 months ago, you did quite a rant with regard to how regulators overregulate and how, yes, we need regulations, but what regulation does is protect those who are already in control and already have the dollars, and it hurts those who are the innovators. And that's exactly what Cathie said. So she put a big exclamation point on your point from that particular show.
Yeah, so regulators regulate on behalf of the regulated. And those who are not regulated are therefore cut out. So, it's called regulatory capture. I can rant on as much as you like about it because I get very, very excited about this issue because it's really serious. It really impinges upon our freedom to really innovate.
Right.
And, just look at China. China is the shining example of this, or the burnished example of this. I mean, China's regulations are overwhelming, and the result is, that it has become very difficult to do business in China. Anyway, back to so what are we looking at here? We're looking at the US Treasury deficit or surplus as a percent of nominal GDP. So we see that the most important thing about this particular chart, I believe, is that we are getting that the deficit is pretty high, and it's recovering somewhat from the disaster of the let me get a
COVID spending, yeah.
COVID spending. It's recovering from the COVID spending. Let me pull up
your laser pointer.
Yeah, I've got it, but I
saw it there for a minute, Larry.
It is there, but what I did is I covered my notes.
Oh, I got it. Okay.
Yes, in the 80s and 90s, when the deficit went to 5%, Volcker slammed on the brakes.
Right.
Now, without a recession, but in COVID, deficit went very, very high, minus 17.5. I mean, it completely eclipsed anything that happened in the Volcker era, and has returned to so-called normal. So, here we are stuck at -5, which spurred Volcker onto, his incredibly tough approach, and here we are at -5. How do we get out of this? We only get out of it the way we got out of it in the 80s and the 90s, and that is innovation.
Right. Now,
And
Cathie gave us 3 methods, though.
That's true.
She said you can raise taxes.
Yes.
And that can be actually literally changing the tax code.
Yes.
You can generate more taxes because the economy gets stronger, and therefore you are bringing in more taxes, which is why the deficit was so bad this quarter, is because the incoming money was much less than what was expected. And then the third way is to innovate our way out of it by being productive. There we go. Yeah.
But the point is, government spending is taxation in one form or another.
Right.
Cathie explained that any government expenditure has to manifest itself ultimately in taxes.
Right.
Either from rapid government, from inflation, or from actual taxation.
Right.
So ultimately, the good way out of this all is innovation
and growing the overall economy so that more tax revenue comes in.
Yes. So we have to look at the impact of innovation, and we have to think about innovation, and we have to spur on innovation. And one of the things that happens is that when you get executive orders clamping down on growth, you're going to impact that innovation. Right. Yeah. Anyway, I get off that particular. So one of the reasons that this whole scare of inflation is, and I posted on this actually last week, I posted a whole rant on this last week, is, the classic reason for inflation is the growth of the money supply.
Right.
People focus on the growth of the money supply, and yet look at the growth of the money supply over the last year or two. It went crazy during COVID because of what the government did in terms of pumping money into the economy. But look at it now.
Yep.
It's -5. I mean, this is more negative than since 1960. You'd have to go back to the 30s to see something like this. In fact, I don't even know if it fell as far in the 30s. It may have.
You have to go back and look. So Larry, so this looks extremely crazy when we take a look at this particular chart. But as I've mentioned in past, when we've been talking about Cathie before, she doesn't go on to actually show the money supply, which is still okay. It's not great, but the money supply is still in a normal range. So the growth has dropped radically, but that's kind of bringing us back to normal. What we don't, and I think you agreed with me last month when we talked about it, is what we don't want to see. We don't need this to continue at this -5 because then you get to a place where the actual supply becomes inadequate to manage the economy.
Yeah, but if you look at my post from last week, you'll see there are 2 factors in inflation. Only one factor only is money supply. There's another factor, and that is the speed at which money changes hands, right. What we call the velocity of money.
Right.
And the velocity of money has been depressed for several years now. So what you've got is a double dip. You've got a dip in money supply, and you have a dip in the actual in the velocity of money.
Right.
And that's really the underlying factor here. And that's why inflation is falling as rapidly as it is. And I think it's going to continue to fall, even if the government turns the tap back on. because I think they're very late to turn the tap back on.
Larry, would that velocity issue be part of what we've also talked about, though, that the aging population is more inclined to not spend and to save, and that the homes are not changing hands? It's the buying and selling homes, whether brand new homes or whether existing homes, is a big part of the economy, and that is tremendously depressed. And so there's no money changing hands with regard to the home sales. So you take that into consideration, along with the population and the wealth all being concentrated in the population over 55, not moving. It's sitting in pensions. It's sitting in money markets. It's sitting in not very much right now in CDs, but there's still a lot of it in CDs. So would that be a big piece of why maybe the money's not moving?
You know, that sounds reasonable. I haven't actually looked at the sources and what could be impacting it, but let me take from my posting this week the actual graph that I showed. And you may be right. Oh, that wasn't good. You may be right. That may be the source of the problem. I mean, the bottom line is people are spending are spending less rapidly. They're tending to not spend at the rate that they did. So here is the velocity of money since 1960.
Oh yeah.
Okay. Now, Cathie didn't show this, but
No.
You'll see 2010, we had this terrible recession, and the money supply, the velocity of money fell very dramatically. People stopped spending almost entirely.
Right.
And it's been creeping down ever since, which is the reason, by the way, that we didn't have inflation, even though the money supply was rising.
Yeah.
So
velocity was still.
This velocity is what offset the zero interest rate era that we lived through.
Wow.
We lived through a zero interest rate period with no inflation. And if people are so focused on money supply for inflation, then they could not answer my question. Why are we not having inflation now?
Yeah.
And look what happened in the pandemic.
Right.
It fell to a never seen before ratio.
Right.
Right. Where, you're getting down to 1 to 1. You're getting to a point where $1 is issued and it stays in that hand for almost a year.
Yeah. Right.
Right.
Yeah.
So the money supply was being pumped into the economy. The Fed was just pumping away, and everybody's saying thank you.
Yeah.
But I'm not, I'm not going to put my hand in my pocket. Now, it has recovered a little bit, but look where it's recovered to.
Yeah, right.
So, yeah, we've had, an oil shock. We've had several other factors. But the velocity has not gone up.
Okay.
And so I really think that we should be focusing on both of these things. Now, I don't know the actual date. I think I downloaded this last week. So yeah, so this was last week's. So yeah, I mean, we're seeing money supply collapsing, down to a record low level. And we've seen the velocity of money collapse to a record low level. Right. So my prediction is that we're going to see a fall off the cliff.
I got it.
The inflation rate's going to fall off the cliff, and again, the Reserve Bank is way behind.
Right.
They're way behind to shut down, and now they were. I mean, it's like you can't teach an old dog new tricks. And
don't talk about old dogs on this show, Larry. It's just wrong.
Shame, my poor old dog. I mean, dear, he is. I'm not talking about me. I'm talking about.
Next slide.
Yeah. So Cathie, if I go on like this, we'll be on for hours. So let's move along. And then, she looks at the 210s yield curve spread. I think you sent me the slide last week, actually.
Yeah.
You said, hey, look at the slide. And, I mean, the obvious statement is we're getting back to normal.
Yes.
The yield spread is disappearing, and that's really supposed to be a good thing. Yes, it is a good thing. It is a good thing. And so that's very important.
And once again, interestingly, I said this on my show the other day, Larry, but you may not have seen that particular one, is the the Treasury when they issued their new bond, the way that they're going to sell bonds in the next quarter, they emphasized the short-term bonds.
Yeah.
Now, by saying they're going to issue way more short-term bonds, they literally would be oversupplying that, which would cause those prices to go down and those rates to go up compared to the 10-year, which would make the inversion worse again. I thought that was interesting.
Yeah, I think when we look back at this period, I think what we're going to see is, very significant mishandling of the fiscal and economic policies, and it's monetary policies, and I think it's very upsetting. You'd think that they'd have learned. I mean, Janet Yellen, I mean, really, seriously bad.
Yes.
One of the worst Treasury secretaries in our history, in my judgment, and we've had some really bad ones.
Yeah,
really. All right, so then Cathie goes to show what real employment really looks like. That temporary help services employment leads total employment. And so, it's on its way down.
Has been for a while. Temporary help service companies have been in trouble, literally hurting.
Yep, that's exactly right. So the risk is deflation, not inflation. And then we talk about existing home sales. I mean, do we have to actually?
We don't even show the slide. Everybody should know this. But there's not going to change. It cannot change. There is nothing systemic, nothing in the system that can be changed fast enough to get this to change anytime soon, because you first have to stimulate homes to be built, and you have to stimulate people to be able to move out of the homes that they're in. Well, and one of those things is going to happen unless the interest rates drop radically.
Yeah, if interest rates drop to 2.5%, then homes will start changing hands very rapidly.
Right.
Because there's a lot of savings built up into the marketplace. I mean, one of the reasons for the slowdown in velocity of money is that homes are not changing hands. So that's a huge percentage of money, of activity in terms of velocity, right?
And nobody is borrowing against those assets either, because nobody even wants to go out and get a HELOC at 7%.
Right.
Especially if you contemplate that the HELOCs are going to drop to 4% in a couple of months or a few months.
Yeah. And of course, a terrible victim of this is auto sales. I mean, auto sales have been in the toilet for some time now, and I don't think it's going to change any soon.
She thinks it's going to drop radically. She thinks that the auto sales are going to drop off a cliff here in the next 6 months.
I think so. I think we've seen a big uptick in auto sales in recent months because because of the pandemic drop and the supply chain drop. But I think all of that's going to, that was kind of like the pig moving through the snake, and I think the pig's just about out of the snake now. So.
The alternative to that, Larry, is there's a lot of statistics that are saying that the fleet is very old. And while cars do last longer, I mean, I know that when you and I were growing up, if a car had 90,000 miles on it, it's like, better get rid of this guy. And now 160, 170,000 is no big deal. But I do think that there's a lot of old vehicles out there that folks are probably at the end of their, at the end of what they accept in terms of the repairs. And so I think that's the offset. So there could be.
Yeah, but there's so many moving parts to this equation.
Right.
Because you've got young people not buying cars today.
Right. That's true too.
So you've got that. You've got cars lasting much longer. You've got that. So the question is, how does that equation balance out? And it's very easy to put these, points on the table, but we need some sort of real numbers. And I'm not sure that any of us have a grasp on the totality of the numbers. Time will tell, but if money supply continues being constricted and velocity stays down, then we will be in this rolling recession. You don't believe there's a recession. I do. I think we've had a rolling recession for some time. Very significant portion of the economy is, in this recession, and it's going to continue for some time unless the money supply is increased somewhere along the line. And, they may not hike, but they're not going to increase the money supply. Mm-hmm. So, and to increase the money supply, what we're talking about is to bring these interest rates back down again.
Exactly.
Until velocity increases, you could have a zero rate and we'd be fine, as we've shown over the last.
I think just to put a cap on that last part, if we drop the interest rates not down to zero, but back to 2.5%, like you just said a minute ago, if the Fed's interest rate and the bonds were around 2.5%, I think we would see more car buying. We would see more house transactions. The economy in general, corporations would be able to borrow more easily. I think it would be a good stimulus at this point, not the kind of stimulus that hurts, but rather one that would be positive.
Well, Cathie is, the summary of, and I'm jumping to the end, but her summary is that innovation is what's going to save us.
Right.
I don't think we need this gigantic innovation. I think we're in a very innovative period anyway. I think that money supply is really the lubricant. And, until you get money supply, even innovation is not going to save you, because people just won't buy it. People just won't. Yeah. Because they won't have the money to buy.
The other side of that, Larry, and I've already spent a couple of hours probably on my show talking about this, but productivity right now may be driven partially by innovation. But the main reason you're seeing this jump in productivity is because we were so unproductive during COVID and during these supply chain shortages. And now companies are being forced to become productive. They want to, and they have time to, but they're also being forced to because they don't have enough employees. They need to become more efficient in order to sell products, because they need to be able to do like Tesla did, lower prices in order to stimulate sales, et cetera, et cetera. But that's an hour show, so we'll move on.
Yeah, so company surveys. This is a company survey that Evercore do, and Cathie showed the slide. And recession is down here, and this is where they are. And notice the trend is down.
This is the survey of their expectations, or how they're feeling about their business right now.
Yeah. So
they're just at the edge of struggling.
Well, no, they're deep into struggling.
I guess that whole bracket would be struggling. Okay.
Yeah. So earning expectations are down right now. Revenue and earnings are weak. People say, oh, they beat estimates, they beat expectations. But expectations, Cathie says, are so far down. And this is the reason that they're so far down.
Actually, she said the average company on the S&P 500 had, not the average, I'm sorry, 30% of the companies on the S&P 500 were had negative revenue quarter over quarter.
Yeah. So this is the same survey, but not just of US companies, but of global companies, including China, Europe, and US. Look where they are.
Yeah. Mm-hmm.
They're at recession. I mean, China is in recession. There's no doubt about it, in my view.
Yeah, and some of the European countries are definitely in recession.
Yeah, some of them are, yeah. And, you know, again, Evercore looking at wages, employment across these companies and wages across these companies. And, you know, we see them down very significantly. And then finally, Cathie talks about commodities. She focuses on commodities.
This was my favorite chart.
Pardon?
This was my favorite chart.
Yeah, but look where commodities are. And, you know, a lot of the commodities are oil, and oil is down very significantly. That should tell somebody something.
Yep.
You know, somebody should actually put a telegraph, you know, in the Fed's boardroom. You know, one of these paper tape things.
Right.
And we should be telegraphing the commodity index to them.
Yes, indeed.
So, you know, their concern is inflation. My concern is quite the opposite, and has been really for some time. And the problem is that the actions they take a year to 2 years to flush through the economy.
Exactly.
And so we're faced with this very, very tough period.
So here, Larry, I think it's important to point out, because this is my favorite chart. The commodity prices are most of them are dollar denominated. The dollar is extremely strong right now, the strongest it's been in decades. And
right.
So the dollar is going to impact this commodity price. But what Cathie points out is that what we are seeing right now is that the commodity basket right now is at about the same price that it was in 1980.
Yep.
So there's no inflation from 1980 to 2023 in dollar-denominated commodities, which is a pretty crazy statement to make. So silver and copper and gold, I mean, gold's in there. You know, it's not. I believe, is gold included? I think
yes.
so.
Oh yeah.
Yes.
Yep.
So you take the entire basket, and we're sitting where we were 53 years ago.
Yep, it's quite amazing. And, you know, I mean, the ages of the modern era, I think we could say, you know.
Right.
And so in the modern era, we've had in dollar terms. Now, you know, the dollar is interesting because, and Cathie pointed this out, you know, look where we are with the dollar. You know, again, if you look at the dollar, you go back to the 70s, you know, after the Nixon shock, we're back to where we were.
Yes.
So, you know, in this whole 210 saga, you know, the dollar really went for a bit and then picked up again by 2015 at zero interest rates, still maintained its strength.
Well, you know, once again, Larry, I hate to always come back to this theme, but the United States is the only major economy that is growing in population, and that is because of immigration. And so you've got Europe declining, you've got China declining, you got Japan declining, you've got Australia, you've got all these economies that are declining in terms of population. And they're showing it's showing up in their GDPs. And so the U.S. economy becomes the go-to economy. The dollar becomes the safe haven again, because it's the only economy that's managing in these times.
Yeah, there's some, you know, Indo-Pacific nations where the population is rising. In particular, I mentioned India because it's a strong economy as well. And I think this points to the future that, China will decline, but India will increase. And the problem is that China's decline is very worrying from a global perspective because one doesn't know what is going to happen politically as a result of that decline. Xi is not a good indicator of what could happen. They could assert their strength while they may, and this, is very troubling. And another country where the population decline is really quite acute is Russia, and we see again they're asserting themselves while they may, and so this could be a very worrying period. So yeah, I mean, US dollar index is amazing to me. I mean, the country just keeps trucking along, and people, every decade, I'm told this is the end of the great American era. Every decade. As long as I can recall, I grew up in South Africa in the 50s and the 60s, and people told me it was the end. It was the end,
Yeah.
It's been ending every decade since the 60s, as long as I can remember. But anyway, I mean, and then Cathie did talk about China's holding of US treasuries collapsing. And, people used to point to this and say, yeah, you see, China is no longer interested in US treasuries. China is now getting rid of its treasuries as the end of US dollar hegemony.
Yes.
Yet the reason that the mainland China is getting rid of its dollar index is for one reason only. It's got real problems.
It's trying to support the yuan. Their own currency is way down compared to the dollar. And
well, they have to maintain it, and they are maintaining it by selling these treasuries and buying yuan.
Right.
And at a point in time, that's a losing proposition.
Yes.
Because at a point in time, they run out of dollars, and then
what? And you got Japan.
What?
You got Japan actually turning slightly the other way this week. So Japan is a net seller. Now Japan all of a sudden, I think, has realized they're at the bottom of how well that's working. And so we've just seen the beginning of Japan, at least neutral, if not starting to buy bonds again.
It would be worthwhile doing a program on Japan one of these days and studying it, because we're at an inflection point of the Japanese economy. Very interesting situation.
Yes.
We could have made this program 20 years ago, 30 years ago, and talked about the end of the dollar, the rise of Japan,
right.
Exactly as we spoke about China 5-7 years ago, or 10 years ago. And so it would be an interesting conversation. I mean, the one thing about Japan's rise and the potential for Japanese hegemony is that, Japan was never, Japan turned its back to militancy after the disaster of the Second World War. And so that was never a risk from a global perspective.
Right.
China, on the other hand, is really embracing militancy and militarism. And so it is worrying because, we've been the policeman, the US has been the policeman for all these years, for good or for bad, for both its population and for the world. But now we have this rise of militarism in China. Anyway, I'm getting off the subject. And,
all right.
And then finally, non-farm US labor costs. This is really talking to your favorites, one of your favorite subjects, but it's fascinating that, we're actually, non-farm labor costs are below the target rate of inflation, or at the target rate of inflation. And they have been higher, particularly, with at the exit of the pandemic. But the Federal Reserve, they spoke about transitory for a while, and then they gave it up because they lost their nerve. And everybody really, you know, laughed at them about this transitory, but it was transitory.
It was, yes. Yes. There was never a doubt in my mind. But
yeah, but people really mock the whole transitory thing, and they denigrate the bank for talking about transitory, and
because those people had never been in business for themselves. They had never gone through these roller coaster economies from the standpoint of a CEO, where you see that you get these outsized situations and then they correct themselves, and they correct themselves either to your benefit or to your detriment, but they always correct. And I saw a paper. I saw a paper a couple of months ago. I thought it was really good. It said, when you see something getting way out there in terms of these graphs, and is way out there, you may not be able to predict the day, but you can predict the fact that it is going to resort to normal at some point. And that's a very good
way. But you know, here's the problem. People in the market have no sense of time.
Yes.
You know, they think about tomorrow. They don't think about next year.
Yep.
They think about yesterday. They don't think about last year. And so wise heads start denigrating the Federal Reserve because it talked about transitory, and the Fed loses its own nerve.
Yes. Yeah. Can you imagine?
And Janet Yellen.
Can you imagine if they'd kept their nerve?
Janet Yellen has no clue.
If they'd only kept their nerve,
yes,
the rates,
yes, we'd
raised the rates and stopped at around 3.5%, 4%, we would be singing a completely different tune right now.
Right. Exactly. And you know, we would be in quote normal times.
Right.
Or we would be, let's say we would be on a path towards normal times, because it wouldn't have happened overnight. It would take time, and maybe more than 2 years, but nonetheless, you know, transitory was the right word. And now the final, I think this was the very final slide of all. No, it wasn't the final slide of all. There was a real zing at the end, but this is the metals gold ratio against the US Treasury that Cathie showed.
This is a shocker.
Yeah, I mean, look at this. I mean, look at this. You talk about losing nerve. I mean, you know, the US 10-year Treasury has departed from what would look to be like the norm, right?
Right.
Now, the last time this happened was back in 1998, 2000. So, I don't know. I would love to see this slide. I think I'm going to relook at the slide.
But even if you go back to 2000, Larry, it followed, even though it was a wide gap, it was following the same trend line all of the time. Right. Since 1998, which is how far this goes back, it always follows the trend line. And all of a sudden now we have a complete divergence from the trend line. And so Cathie says, for her, this slide said, those interest rates are going to drop rapidly, that the Treasury rates are going to drop rapidly. We saw a pretty rapid drop this week, maybe the most rapid ever in a single week. In that yields dropping from 5 to 4.55 on Friday night, as low as 4.51 earlier in the day on Friday. I believe that continues, although I do think there will be a pretty hard stop at 4.25. Gary Black thinks there's going to be a hard stop at 4. So I don't know who's going to be right, but I think definitely we're going to see, this is a perfect slide to show there has to be a drop in this interest rate.
So Stanley Druckenmiller is long, very long on the long bond.
Yeah. He thinks it's going, the bond is going down. He thinks interest rates are going up.
Yes.
So that this slide would be even worse in the future. Then what? I'm not sure we know what would happen if this slide continues to be true or gets worse.
Indeed. Indeed. So the question is, would metals and gold take off?
Yeah.
If his projection is correct.
Right.
Because that's the other
option.
That's the other leg of this, right? It's, it gives you thought. We can't be too certain of ourselves. Well, I'm pretty certain of myself, but when Druckenmiller says something, you have to actually think about it quite seriously.
Well, that Larry is the one, probably the one item where you and I are the furthest apart. I think we see the bonds dropping radically even before the Federal Reserve. And I think that's going to be mostly because, not this slide, but because the inflation rate is dropping so radically, and real inflation, real interest rates, I don't think can maintain at these levels. There'll be too many hogs that want to buy those bonds as they're dropping and not miss out on the opportunity. I mean, as interest rates are dropping.
Interesting.
Yeah.
Interesting indeed. So we're saying that we believe that the US Treasury is going to drop sympathetically to the metals gold ratio. But there are others who are saying the metals gold ratio will probably rise because these have to move in. Well, they would move in conjunction. But it's interesting. I don't know. It does give me pause, but I strongly believe that we are going to see a significant drop in interest rates. And I think we're going to have to see the Federal Reserve have to get off its seat and admit,
Right.
I mean, they could declare victory. They could easily declare victory, use it as a way to declare victory. And then Cathie's final word was on Bitcoin, of course. And, she shows the slide and says, Bitcoin is flight to safety. There's no counterparty risk. She's raising the issue of the counterparty risk from these bank failures, innovation at its best, and that it's a flight to safety. Well, if you're right, and treasuries are going to rise and interest rates fall, question is what happens to Bitcoin?
Well, and I would say to Cathie that she should have been, I don't want to say honest enough, but I think she should have at least mentioned that this rise over the last month or so might have something to do with ETF. And I don't know enough about the Bitcoin thing to really be a student of it or to be able to talk to it. But every headline I've seen has talked about the fact that if these ETFs come out, making Bitcoins more liquid, then this is going to, create opportunity for Bitcoin to be more useful. And so that the increase has been largely on the back of the hope that the ETFs get approved and start to be sold.
Yeah, they gave some numbers at the conference yesterday. I don't know that what you're saying is correct. It could be sentiment is improved because of the potential for ETFs being approved. It's possible, but the rise in the price has been pretty solid. It wouldn't surprise me to see a further rise. By the way, just as an aside, that Tesla still maintains some Bitcoin, and it's showing a very big profit. If they hadn't sold when they did, they'd have more than $1 billion profit. I think right now they have something close to 200, maybe 100 million of profit or even more, but they would have had more than, would have several billions of profit.
Yeah, yeah.
Anyway. And then, the one thing that Cathie did do at the end of the session, and which is really worth watching, was she talked about this miracle of gene editing finally, being used in treatment. Last year, we saw a cure for a very rare kind of leukemia, a young girl who was cured. We haven't seen an approval of that particular treatment, even though she was cured. But this year, this most recent conference, at a most recent conference, we saw a woman who was cured from sickle cell disease. And Cathie, it's worth watching that.
Yes. Mm-hmm.
That video where the woman gives gives testimony about how she was cured. Quite a remarkable woman who really struggled her entire life with the sickle cell disease, brought up 4 children, went to college to become a nurse. The sickle cell disease really crippled her from that, but she was treated by this gene editing, the first, I think, to be treated under this gene editing, and evidence is that she's fully cured and she's living an ordinary life now, and for which she's very grateful. But it's a potential huge breakthrough, and we've seen some medical breakthroughs in the last year or so. So Cathie is very excited about that this whole medical innovation thing.
Yeah, that could be another hour in terms of what the future is going to look like the next 10 years. It's the next 10 years is, should you and I live so long, it will be in a fascinating time to see what's going to happen in medicine, in energy, in foods, in the way we distribute products and even foods. I mean, I think it's going to be a remarkable decade.
I think we'll manufacture food in the future. Manufacture food rather than grow it or raise it as cattle, or raise it as living creatures. I think we'll manufacture it, but I think it's going to take a little bit of time. I wish, that had included it as one of its what do they call them, innovations, because I think that is a more important innovation than many other innovations. I mean, that could change our world so dramatically. You talk about reduction in global warming. I mean, it would make a huge impact on the quality of life. But multi-omic sequencing is what they're focused on. I think innovation in food is potentially even more foundational to human existence than multi-omics or even AI.
Yeah. It's all just crazy fascinating to watch what's developing. Well, Larry, as always, I want to thank you for jumping on board and helping all of us to understand what Cathie said, because Cathie's very bright, and sometimes she doesn't take the time to. I think she assumes her audience has a lot of understanding of economic principles, and so she doesn't go into depth of explaining all of that each time. So we do that here. Larry explains it so that I'll understand it.
Thank you for wearing your Star of David. I should have worn mine at this program because I feel very strongly about it, and I think right now we're going through this terrible period of anti-Semitism, which anyway.
Yeah, well, I'll make a clarifying statement. I hope that I think you'll agree with me 100%. I feel very badly for the citizenry in Gaza.
Oh yeah, I mean,
I feel very bad for them. I feel very bad for the loss of life. I feel very bad for the injured. I feel very bad for the fact that they've elected and allowed Hamas to be their leaders for the last 30 years. I feel very bad for all of that. But when you compare, there's no possible way that you can come up with any way to show a moral equivalency between what Hamas did to Israeli citizens in terms of killing, maiming, raping, and then actually kidnapping
But
children and old people.
quite apart from the war that's going on and the backwards and forwards and the terrible things that's going on in Gaza and in Israel, quite apart from that, my great fear is this terrible anti-Semitism that has arisen as a result of it.
Well, that's where I was going, Larry.
Yes. Okay. Sorry.
Yes.
I just.
So for folks out there, that have any negative feelings about any other culture, why Jews? Why is it always the Jews that get this negative impact? And the United States has been the haven. It's been the one place in the world where every Jew could feel like, and not always, Larry. I grew up.
But in the modern era,
Say after 1970, I think 1970 forward, Jews in America could feel like, you know what, I'm no different than anybody else. Everybody's good. But now all of a sudden we're seeing this rise on our campuses, among our young people, among the professors. This is extremely sad.
Yeah, it really is. And, I hope we live to see the end of this as well. And I hope to see some peace in the Middle East.
Yeah, well, that would be another hour show. So I guess we'll end it. Larry, can you stop sharing your screen for just a second?
Yes.
You did that already. Never mind. What's wrong with me? I'm okay. So for all of you Larry, thank you for being on board. And for all of you out there, it has been great talking to you.